The Peter Schiff Show.
Today's podcast is sponsored by Netsuite, the easy-to-use cloud-based business management software for every aspect of your business. By popular demand, Netsuite has extended its one-of-a-kind flexible finance program for a few more weeks. Head to netsuite.com/gold. Today's podcast is also sponsored by Harry's. Right now, you can get a 5-blade razor, weighted handle, foaming shave gel, and a travel cover for just $3 at harrys.com/gold. Good evening, everybody. For those of you who recognize the bookcase in the background, I'm doing this evening's podcast from my office in my Connecticut home. And this is where I used to do my YouTube videos. This is before the Peter Schiff Show podcast, before Schiff Radio. When I first started doing video recordings, it was around the time of my campaign, of my 2010 Senate campaign. I used to record usually maybe around 10-minute updates. Because remember, back in the day, you could only do a 10-minute YouTube video. That was as long as you could make it. And so I would try to keep them at under 10 minutes so that you could see it in one YouTube. Otherwise, we'd have to have a part 1 and a part 2 in order to get them up. But I would try to do one under 10 minutes. And I was recording them in this room up here. And then what happened is I eventually built a studio down in my basement, and I started doing all the podcasts from down there. Well, I mentioned recently I had to redo that room. We had some plumbing issues and some water damage, and so everything got stripped. The whole room finally got finished. But given how little time I actually spend in Connecticut, I don't know that we're even going to redo that room as a studio. We may just make it another bedroom down there in the basement. So for now, while we're deciding what to do, I'm just now back upstairs to do the podcasts from my office. So for those of you who recognized it, that's what's going on. But anyway, so I want to start off the podcast by talking about the big sell-off that we had in gold and silver on Friday, which followed a generally up week for gold. Gold was up 3 out of the previous 4 days, pretty much up about $20 an ounce on Monday, Wednesday, and Thursday, and down maybe about $20 an ounce on Tuesday. So we were ahead. I mean, gold was almost up 2% on the week on Thursday. And despite that, gold stocks were barely positive. They were only up about 0.5%. And that's because when gold was down $20 on Tuesday, they got destroyed. Gold stocks were down 4%. And I've been talking about that on this podcast. The longs have no conviction. They are scared. Anytime anything bad happens, a little bit of a decline, they run for the hills, which has characterized this bull market. It is climbing the mother of all walls of worry. That's why I said on a prior podcast that even though you're buying gold at record highs, you're a contrarian, because most people, even the longs, don't believe the market. And they've got one foot out the door the entire time looking for any signs of trouble. And that's exactly what happened on Friday. There was kind of like a 1-2 punch again that knocked gold down. I think it was down about $70 on Friday, closed just below 2,300. It was flirting with 2,400 on Thursday and closed below 2,300 on Friday. Silver got clobbered. It had gotten back up to 31.5 on Thursday. And then on Friday, it was down a couple of bucks. It closed close to $29, not below, but kind of near $29. So a big drop in gold and silver. And what happened early in the morning, this is before we got the non-farm payroll numbers, which I'm going to get into on this podcast in some depth. But before that was announced, the market was down. Gold was down about $40. And I woke up on on Friday morning, and I saw gold down $40. I had no idea like why it would be down, especially in front of a jobs report. Normally, you wouldn't see that because people would be worried. What if it was a weak number? Right? People would not want to sell gold in front of that number. Normally, if there's a $40 move in gold on a jobs day, it's in reaction to the number. Right? The number has come out, and it's not what was expected, and so there's a bigger move in the markets as they kind of readjust to the new data. But gold was already down $40 and the market hadn't even opened. And so I wanted to know why. So I go online, I do a little research, and I see the news out of China that China had announced that during the month of May, they didn't buy any gold. At least officially, they said they didn't buy any gold. They had bought gold for 18 months in a row, and in the month of May, they didn't buy any. And apparently, this is bad news. When the traders learned this, they immediately sold gold. Oh my God, China stopped buying. I mean, it's 1 month. So what? I mean, as far as I'm concerned, that's a bullish announcement, I think, because if gold made a record high on Friday, or in May rather, without the Chinese buying anything, to me, that's pretty bullish. Because normally the Chinese have been buying, and even without the Chinese. Now, of course, when I say the Chinese, I mean the government. Obviously, Chinese people, the people themselves, didn't stop buying gold. I'm sure they bought plenty of gold. But the government didn't buy any gold for that month. But even without the government buying gold, gold made a new all-time record high without China helping. So to me, that's actually bullish, that gold didn't even need Chinese buying, and it still made a record high. But the way the markets reacted to this announcement was like, oh my God, that's it. China's done buying. Why would they be done buying? They didn't buy gold for 18 months to stop now. This is just the beginning. They got a lot of gold to buy. Does it make sense that they backed off a little bit? Like all of a sudden, gold is breaking out to a new record high. Maybe the Chinese were like, okay, let's pause a bit. Maybe we'll get a little bit of a pullback. We've bought for 18 months in a row, and now the market's kind of running away. Let's take a step back. Let's see what happens. Maybe we could get a little bit of a pullback, which ironically, they got based on announcing that they didn't buy. The markets have just given China a gift, not only because the market fell $40 on the news that China didn't buy any gold in May, giving them the opportunity to buy more gold now in June. But then we got the non-farm payroll numbers that came out later in the day that were stronger than expected, and that sent gold down another $30. So down $70 on the day. And so if the Chinese didn't think down $40 was a bargain, I'm sure they're buying tonight. I'm doing this podcast on Sunday night. I'm sure that the Chinese government is going to be backing up the truck and buying into this decline. They're probably laughing about it, about how foolish Americans are or Europeans to give them this gift and to react to this little news announcement. They'll probably keep this up their sleeves for some future announcements when they want to buy more gold. They'll put out a news announcement like this so they can convince foolish Americans to sell them their gold at a lower price. And in fact, when they announced the fact that they didn't buy any gold, they were also announcing other economic data that evening. One of them, or one piece of data that came out, was their trade surplus, which swelled. The Chinese trade surplus is kind of the mirror image of America's trade deficit. And our trade deficit really shot up. I think I mentioned that on the last podcast. We had a big jump in our merchandise trade deficit, which is going to shave off a lot from our GDP. And in fact, when I recorded my last podcast, I mentioned the downward revisions to the GDP from the Atlanta Fed. And I said that I thought that was just the beginning of a lot. And of course, the very next day on Monday, they slashed the estimate again. for the estimate for Q2 GDP. But China announced that their May trade surplus swelled to 82.62 billion. That was a 7.6% increase, or as a result of a 7.6% increase in exports. And if you look just with the United States, their surplus with the US alone in May ballooned by 13% to $30.8 billion. That is a strong economy. One way to know if an economy is strong or weak is look at how much they're producing. Strong economies produce surpluses. Weak economies produce deficits. So it's China's economy that's strong. They've got the surplus. And one of the things that they're going to be doing with their surplus is they're going to be buying gold. What else are they going to do with it? What is the Chinese government going to do with these enormous surpluses? Because assuming that Chinese exporters sell their dollars on the foreign exchange market for RMB and the Chinese government takes the other side of the trade, what are they going to do with the dollars? What are they going to do with the dollars they already have? What are they going to do with this massive stockpile of U.S. treasuries? Obviously, they're going to convert them into gold. It's ridiculous that U.S. traders would look at a single month where the Chinese backed off of their buying and just conclude that they're done, that this is it. China's out of the gold market, and this is horrible news. I thought it was bullish news that we made a new high without the Chinese. And I also think the markets got the jobs number wrong. Because once again, right, we got a non-farm payroll number that was greater than expected. And the markets immediately react. The bond market sells off. The US dollar rises and gold dumps, even though it's already down $40, right? It dumped again based on this strong jobs report. But once again, the headlines are very misleading because all you have to do is look beneath the surface, and you don't have to look that deep. It's not like this is hard to figure this out. It should be obvious that these numbers mean nothing, that I don't care what the government tells us is happening with job creation. We have a weak labor market in the United States, and the non-farm payroll reports that came out on Friday confirm that we have a weak labor market, even though the government claims that 272,000 jobs were created in the month of May. Anyway, we're going to get into that report on the other side of this break, so stick around. Here's some quick math. The less your business spends on operations, on multiple systems, on delivering your products or services, the more margin you have and the more money you keep. But with higher expenses on materials, employees, distribution, and borrowing, everything costs more. So to reduce costs and headaches, smart businesses are graduating to Netsuite by Oracle. Netsuite is the #1 cloud financial system, bringing accounting, financial management, inventory, HR into one platform and one source of truth. With NetSuite, you'll reduce IT costs because NetSuite lives in the cloud with no hardware requirement, access from anywhere. You cut the costs of maintaining multiple systems because you've got one unified business management suite. You improve efficiency by bringing all major business processes into one platform, slashing manual tasks and errors. Over 37,000 companies have already made the move. So do the math. See how you'll profit with NetSuite. By popular demand, NetSuite has extended its one-of-a-kind flexible finance program for a few more weeks. Head to netsuite.com/gold. I'm not. All right, we're back. Just having some technical issues here. I was hoping to resolve them during this commercial break, but I wasn't able to do it. Anyway, so I want to get into the non-farm payroll number. So the consensus was for 182,000 jobs being created in May. So that's what everybody was looking for. And that would have been a slight improvement over the 175,000 jobs that were reported to be created in April. Well, first of all, the April number was revised down just a bit, 10,000 jobs lower, so 165,000. Oh, and by the way, before we got the number on Friday from the government. We got the ADP number on Wednesday from the private sector. And that one came out below estimates. They were looking for 173,000 and we got 152,000. And the prior month was also revised down from 192,000 to 188,000. And so these are private payroll jobs. They don't even include the government numbers. But they're at 152. So that was a weak number. And so going into the official number, maybe there were some people that thought that this one would be weak as well. And I think that the ADP number is likely to be more accurate than the government number. But anyway, the number came out at 272,000. That was well above even the highest estimate on the street, which was 225,000. The range was 150,000 to 225,000. So that headline number is what riled the markets. That's what caused the dollar to rally. That's what caused bonds to fall, yields to rise, and that's what caused gold and silver prices to decline. That and the average hourly earnings numbers, which were higher than expected. So inflationary. The average hourly earnings were up 0.4 versus expectations of up 0.3 and double the up 0.2 from the prior month. And average hourly earnings year over year, which were supposed to be up 3.9, were up 4.1. And the prior month, the year over year number went from 3.9 to 4. So this is bad news, right? Because we're going further away from 2%. Instead of going down, we're going up. So we got stronger non-farm payroll number and hotter inflation numbers, right? So that's what was the market mover. Now, I agree that inflation is hotter than the markets understand. The inflation is not caused by rising hourly wages. It's the other way around. It's rising inflation that is causing average hourly earnings to go up, right? So you've got the cart before the horse if you think that the rise in earnings is what's going to cause more inflation. It's the inflation that's causing the rise in earnings, and it's not a real increase. It's a nominal increase because prices are rising faster than wages. So workers are falling further behind as a result of this, this combination. But the jobs number was not strong, right? Now, first of all, just looking at the rest of the official report, the unemployment rate went up to 4%, right? From 3.9 to 4. Nobody expected that. In fact, a lot of people thought the rate was going to drop to 3.8. So unemployment went up. That's a weak market. Private sector payrolls rose by 229,000, following a downwardly revised 158 from the prior month. That was well above estimates and well above the ADP estimate for private payrolls. Because remember, ADP estimated private payrolls at 152,000. Oh, and by the way, we also got the JOLTS report earlier in the week. That was weaker than expected, considerably. The JOLTS report is job openings. And in the prior month, there was originally reported 8.488 million jobs available. That was revised down to 8.355. The consensus for April was 8.4 million jobs. That was revised all the way. I mean, that came out at 8.059, way below the low end of estimates. This is one of the lowest numbers for available jobs that we've had in quite some time. That is evidence of a weak jobs market. Employers are not looking to hire as many people, right? Yet despite that, we supposedly, had all these new jobs that were created in April. Now, manufacturing, still a small number. We created 8,000 jobs, but the expectation was for 5,000, although we revised the prior month's 8,000 down to 6,000. So manufacturing only ended up with an extra 1,000 jobs versus what had been initially reported and what was expected. So really all the additional jobs were in the service sector, right? Not the goods producing sector. That's why these trade deficits that we have are going to get bigger. But look at the labor force participation rate. It was at 62.7 in April. It was expected to hold steady at 62.7 in May. And instead, it went all the way down to 62.5. Now, wait a minute. We created all these jobs. Why didn't the labor force participation go up? Because now more people have jobs. That's what you would expect. But no, labor force participation went down. And it's really because fewer people are working. We didn't create 272,000 jobs. That's BS. That's what the government claims, but that's not what actually happened. So let's look at what the statistics that came out in the other jobs report that comes out at the same time, right? Every time we get a jobs report, we get this household survey. And that's actually where they get the unemployment rate. But the household survey also has an estimate of job creation, right? You have the establishment survey, which is the official non-farm payroll report. And then you have another report that is released at the same time that doesn't really garner all of the headlines. And that is the household report. And there has been a big dichotomy between those two reports going on for years now that have shown contradictory information. So according to the household survey, the number of employed Americans in the month of May actually collapsed by 408,000. So 408,000 fewer people had jobs. So all these jobs were created, yet 408,000 fewer people actually had jobs or were employed. Well, how is that possible? Well, again, it's possible because the jobs that were created for people who already had jobs. So if you had a job and now you had to take a part-time job to make ends meet, that's a new job, but it's not a new person in the labor force. So maybe somebody just threw in the towel and decided that they're not going to work anymore, and somebody who is working took a second job. There you have a new job created, but you also have the labor force participation rate going down because the job that was created went to somebody who had a job. And at the same time, somebody who used to have a job or used to be looking for a job decided they didn't want one. And so they left the labor force. So that's what's going on, right? The jobs that are being created for people who already have jobs. And that's also supported by the statistics. According to the household survey, in the month of May, the month that we had this strong jobs number, the number of people with full-time jobs collapsed by 625,000. Now only 133.3 million Americans have a full-time job. That is the lowest number of Americans with full-time jobs since February of 2023. So it's been over a year. And during that time, all of the jobs that have been created were part-time because full-time jobs have been destroyed. And in fact, if you look at the month of May, the number of people with part-time jobs surged by 286,000. That's almost exactly the number of jobs that the government claims were created, to 28 million. That is a new all-time record high. So while full-time employment is collapsing, the number of Americans who have part-time jobs has surged to an all-time record. Now, again, some of these people have one part-time job. Some of these people have multiple part-time jobs. Some of these people have full-time jobs and they have part-time jobs, right? This is a sign of a weak economy. When people are forced to work multiple jobs, it's because the economy is weak. It's because the labor market is weak. Most people want one job. And in a strong economy with a strong labor market, you can survive on one job. You can support your family on one job. But when inflation is rising much faster than wages and you can no longer make ends meet with a single paycheck, that's when you have to go out and get another paycheck or a third paycheck. And as a matter of fact, too, if you look at the government numbers, the official survey, if you look at the birth-death model, and I talk about this birth-death model, there's some controversy with respect to exactly how the birth-death model is incorporated into the headline number. But according to the government, they assumed that 231,000 jobs were created as a result of the birth-death model. Now, the birth-death model has to do with businesses that the government assumes were created. And the government assumes that those companies that were newly formed, right, they were born, they didn't exist in the prior month, they were born during the month of May, that these newborn companies went out and hired a bunch of people. And so they have to guess at how many people these businesses that they assume were created actually hired. Now, what if they're wrong? What if no businesses were created in May on net? In fact, I'd be willing to bet that a lot of businesses closed their doors. I mean, I'm reading all these articles about companies going out of business. Record numbers of companies, retail, restaurants, stores that are just shutting down. I would guess that the government, which is hopelessly overly optimistic, probably when the birth-death model is the most inaccurate is kind of nearing inflection points, like when the economy is either going into or coming out of a recession, right? They're probably the least reliable. They may never be reliable, but they're probably even less reliable during those periods of time. Because if you have a bunch of government statisticians who believe the economy is strong, well, they're just going to assume that a strong economy is creating jobs. But the economy is actually weak, right? And so a weak economy would be losing jobs. But you're not going to assume that the economy is losing jobs if you're living in a delusion that we've got this booming economy. And if you look at the number of jobs that the government assumed with the birth-death model, that's 85% of the total. Now, I don't know if 85% of the total represents those jobs, but it just shows you in proportion how many jobs the government just takes on faith were created. So I don't put, any real value into any of these numbers. I think they're highly politicized and they're historically revised, not just the month later, but 6 months later, a year later, they go back and they revise these things. The household survey, to me, is likely far more accurate than this number. And all the anecdotal evidence around the job market, look at the collapsing savings rate. Look at skyrocketing credit card debt. Why is this happening, right? If people had jobs and were getting jobs, they would have paychecks where they can afford to buy stuff. And they would be able to save some of those paychecks. They would be able to use those paychecks to pay down their credit card debt. The fact that savings is plunging to record lows, at the same time, credit card debt is soaring to record highs. What does that tell you about the labor market? The jobs market is weak. People don't have the purchasing power, so they have to resort to depleting their savings or running up their credit cards. Anyway, we got another commercial. We're going to take a break and we'll be right back. In my early days, I faced a pivotal moment in my career. Instead of following the herd into traditional finance, I charted my own course. Blazing your own path is the best way to succeed. Sometimes you have to challenge the status quo and blaze your own trail. That's what Harry's did.
Seeing people tricked by expensive razors, Harry's took a stand. Instead of pricey options, they offer high-quality razors at a fraction of the cost. You know, in the world of finance, I always advocate for smart investments and sound financial decisions. So when it comes to personal grooming, I apply the same principles. That's why when it comes to grooming my face, I use Harry's. Harry's understands the value of quality without breaking the bank. Their razors provide a smooth shave every time, and their shaving gel leaves my skin feeling refreshed and moisturized. So don't settle for the status quo. Blaze your own trail with Harry's. Get started with a $13 trial set for just $3 at harrys.com/gold. That's harrys.com/gold for a $3 trial set.
All right, so I'm talking about the jobs report that the media and the market overwhelmingly looked at this jobs report as a strong report, merely because the government reported 272,000 jobs were created. Big deal. I mean, first of all, that's not even a lot of jobs. It's just a lot more than we expected. But the number doesn't even pass the smell test. At the same time, the official unemployment rate went up to 4%. This is the first time it's been at 4% in years. And it's probably going higher than that. And labor force participation at 62.5%, that's a pretty low rate. A lot of people are just thrown in the towel and are leaving the labor force. Again, that's very inflationary. Fewer people working means fewer things being produced, higher prices, bigger trade deficits. This is all weak for the dollar. The dollar shouldn't have rallied on this news. Now, the bond market sold off. I agree with that move. The bond market should sell off. It should sell off more, not because the labor market is strong, but because inflation is strong and because a weak labor market is going to lead to even higher inflation because it's going to lead to less production and more money printing. And more money printing, that's inflation. Now, when this news came out, the markets thought, maybe because of this, the Fed won't cut rates as soon as we had hoped. Maybe the rate cuts are going to come a little later, right? That's really what's driving the market. It's how the markets perceive the non-farm payroll numbers will impact the Fed and how soon we're going to get a rate cut, especially since other central banks already cut rates. On Wednesday, the Bank of Canada became the first central bank to lower rates by, I think it was 50 basis points. And then the ECB cut on Thursday by 25 basis points. Now, neither of these central banks should have cut rates because the official inflation rates in both the Eurozone and Canada are well north of 2%. Yet they're cutting rates anyway. So they shouldn't be doing that. In fact, I watched a press conference with Christine Lagarde where she's talking about how they're committed to fighting inflation. All right, well, why are you cutting rates at all? If you're so committed to fighting inflation, why cut rates? When inflation was below 2% in the Eurozone, by a lower amount than it's above it now, right? We're further above 2% now than we were below it when interest rates were negative in the Eurozone. Negative, not just zero, negative. And they were doing their asset purchase program. And the reason they said they were doing this, the reason they kept interest rates negative and kept buying government bonds, they said that inflation is too low. We need to get closer to 2%. But they didn't want to hit 2%. Remember, their target in the ECB, while the Fed was talking about 2%, they always said we want to get close to, but less than 2%. So they never even wanted to get to 2%. Now, I don't know what close to, but not 2% is. Is it like 1.9 or is it 1.99? I mean, how close without touching 2% did they think they had to get, which was so ridiculous. And I pointed this out at the time. But when inflation was like 1.6, 1.7, apparently that wasn't close enough. They had to keep rates negative. They had to keep printing money. Well, now inflation is much closer to 3%, than 2% in the Eurozone. So we're further away from being close to, but less than 2%. So why cut rates? In fact, they should be raising rates. They should be shrinking their balance sheet. They should be as aggressive now, if not more so, to bring the rate of inflation down as they were to bring it up, right? It's like they were so desperate to get more inflation. when it was just a little bit below 2. But now that it's way above 2, it's not a proportionate response. They are not, extra tight to get inflation down the way they were crazy easy. I mean, interest rates had never even been at 0. Interest rates were at all-time record lows, and they had an unprecedented asset purchase program when inflation was a little bit below 2%. Now that it's much more above 2%, interest rates aren't even high by historical, precedent, let alone a record high. So it's not the same type of reaction. Apparently, the ECB thought too low inflation was much bigger problem than too high inflation, right? Too high pales in comparison to too low. And I guess you could say the same thing for the Federal Reserve and everybody else, because, the Fed had rates at 0 when inflation was below 2. And now that it's much more above it than it was ever below it, rates are, in the low 5s, and they're talking about cutting them. So a much more timid response to inflation way above target than their aggressive, unprecedentedly aggressive response when we were just slightly below target, which really shows you that the target was all a bunch of BS the entire time, right? I mean, that was just a pretense to print money. They were looking for an excuse to create inflation. And so they made one up. Oh, we're below 2%, which in reality, we never were, because the numbers are lies. We never had inflation below 2%. We just had a fraudulent way of measuring inflation so that we can pretend that it was below 2%. And then we had to, oh my God, it's, pretend inflation is below 2%. So now we need all this money printing. We need 0% interest rates. But the rest of the economic data that came out also supports a weak job market. The weekly jobless claims spiked up to 229,000. The consensus was 216,000. The prior month was revised up from 219,000 to 221. The 4-week moving average rose from 222.5. Actually, no, that actually went down to 22.25. But all the other numbers went up. I already mentioned that the trade deficit. Actually, no, I didn't have this number for the prior podcast, because we just got in the prior podcast I talked about the trade deficit in goods, the merchandise trade deficit. This week we got the consolidated overall deficit, which is not as big because the U.S. still enjoys a surplus in services, so that offsets the deficit in goods. But it was still a big jump from the prior month, which was 68.6 to 74.6 billion in the month of April. They're a month behind on the trade numbers. But look at the challenger job cuts. I mean, a little bit fewer than the prior month, which was 64,789. We got 63,816, but that's still a big number. I mean, we've had large announced job cuts all year. It's in January was the smallest at just under 35,000, but over 82,000. No, that was December, rather. This year, that was the report in January. So the January number of job cuts was 82,307. And then February, 84,638. March, 90,309. April, 64,789. And now the May number. But these are all big numbers, bigger than they used to be. So there's a lot of jobs that are being cut. Other weak economic news that we got earlier in the week, other than jolts, we got the ISM manufacturing number, which was 48.7, a very weak number, down from 49.8 in the prior month and below the lowest range of estimates. Construction spending also down 0.1, down 0.2 the prior month. They thought it was going to be up 0.2. Instead, it was down again. Factory orders also pretty weak. The only strong number that came out during the week, other than this supposed non-farm payroll number, which I don't think was really strong, was the ISM service number. And that came out at 53.8. So that was actually a stronger number, much stronger than had been anticipated. But that, I think, was the outlier, because pretty much all the other economic data that came out was weak. But in any event, so I was talking about the rate cuts. So we got rate cuts from the Bank of Canada and the ECB. All of this is bullish for gold. I mean, in a way, you could say it's supportive of the dollar, which would, in theory, create a headwind from gold. But as far as I'm concerned, it's bullish for gold. Gold has been rallying without the dollar being weak, right? The dollar index still around 104, 105, been trading in that area. It's really been going sideways for the last year or two. And during that period, gold keeps making new highs. So it's not about dollar weakness relative to the euro or the yen. I mean, the dollar has been strong relative to those currencies, or stable. All those currencies have been weak. Gold hits record highs in every currency. And the fact that the ECB and the Bank of Canada are already throwing in the towel on the inflation fight. I mean, as far as I'm concerned, they threw in the towel when they stopped hiking. But now they started cutting. And they're not going to stop, right? I mean, these are just the first of several rate cuts that are going to follow. It's not going to be one cut and then they're going to start hiking again. They've already committed to cutting rates. And so the question is, when are they going to cut again? The Fed, of course, hasn't cut yet, but it's a foregone conclusion that they're going to cut. So the only question is, how soon do they cut? Not, are they going to raise rates? So all this is bullish. None of these central banks is going to do what it takes to bring inflation back down to 2%. They're just not admitting that yet. So they're all trying to pretend that they still have a 2% inflation target and that they're committed to hitting that target. But at the same time, they're easing, they're cutting rates, or they're talking about cutting rates. So their rhetoric, their deeds don't match their rhetoric, right? They're talking the talk, but they're not walking the walk. And so pay attention to what they're doing, not what they're saying. So if they're trying to misdirect you with their rhetoric and they're talking about how we're committed to lower inflation on the one hand, but then they're cutting rates, even though inflation is not anywhere near 2%. Now, what are they saying? Well, we just assume that inflation is going to keep falling, and so we can start easing. Well, why didn't they make that assumption when they had rates at zero or negative and inflation was still below 2%? Why didn't they say, we've printed a lot of money, we've kept interest rates low for a long time, even though inflation is still below 2%, we're going to start hiking now, because it's clear that inflation is going to go up, right? It's going to trend higher based on what's in the pipeline. No, they said we need to wait. And in fact, with the Federal Reserve, not only did they wait for inflation to be 2%, they said we want it to be above 2%. We want to make so sure that we are at 2% that we're not going to stop at 2%. That's when they introduced the concept, too, of inflation averaging. They wanted to make up for the years of sub 2% inflation with some years of above 2% inflation. But also, they said they wanted to make sure that the move above 2% stuck, that it wasn't like a fluke, like we didn't go back above 2%, then come right back down. So they wanted to make real sure. They wanted to stay easier for longer just to make sure that inflation got to 2%. Well, why don't they want to do the same thing now when it's way above 2%? Why are they already assuming that an inflation rate that's 3% or 4% is going to go down to 2%? And so therefore they can start cutting in anticipation of that, right? They don't want to wait to see the whites of the eyes like they did before. They didn't want to anticipate. And in real time, right, I criticized the Fed for what it was saying, because prior central banks had always said, you can't wait. You can't wait to see the whites of inflation's eyes before firing. You got to anticipate, right? You can't let the inflation genie out of the bottle. Where did that expression come from? It came from the fact that you have to act preemptively, that if you wait for inflation to manifest itself, if you let that genie out of the bottle, it is very hard to put it back in. And so therefore you want to err on restraint. So what the Fed should have done, what the ECB should have done, if they really cared about keeping inflation contained at 2%, they should have acted preemptively. But they all said, no, we can't afford to do that. We don't want to take any actions that might unnecessarily harm the economy when we don't have any proof that inflation is 2%. So let's actually wait for the genie to get out of the bottle, and then we'll put it in, right? They broke every rule in the book, right? Every central banker 101 rule, they just threw it out the window. They said, we can't do that. We can't be preemptive. We just want to make damn sure that inflation is above 2% before we do anything, right? So they were willing to give, a lot of leeway to that and keep conditions easy, waiting for that confirmation. Well, now they're not doing the same thing. Now they're just making an assumption that inflation is going to come down, and they're already cutting rates in anticipation. At least that's what the ECB is doing, and that's what the Bank of Canada is doing. Now the Fed is talking about it. The Fed is basically taking additional rate hikes off the table, and they're preparing the markets for rate cuts, even though inflation is nowhere near 2%. And if you look at the fiscal situation, that argues for much higher inflation. Look at what's happened in commodities. The recent correction, we've had a bit of a correction in the last week in copper prices, in oil prices. But year to date, we still have considerable gains in those commodities. And there are other commodities that are continuing to move higher. So the overall price level has got a lot of pressure. And so all of the anecdotal evidence would suggest that inflation is on the rise. Yet the central banks are either cutting rates or preparing the market for rate cuts. All that is actually very bullish for gold. It's not bearish, it's bullish. The central banks have surrendered, right? They're not fighting the war. They've already conceded defeat. They just can't come out and admit that. And so they can still pretend. And as long as the markets are willing to accept this pretense, because so far nobody, other than guys like me, nobody in the mainstream is pointing this stuff out. So everybody is just accepting this. But where they're going to be tested, where the credibility is going to be lost, is when the inflation numbers take a decided move higher. And now the central banks are really between a rock and a hard place. Because if they reverse course and resume hiking, the markets are going to get killed. The stock markets, the bond markets, real estate markets. I mean, it's going to be a bloodbath when the central banks pivot, or if they pivot and start hiking. I guess none of this is priced in to financial assets. And certainly, the U.S. with an election coming, there's just no way that Powell is going to hike rates before the election. It's just not even possible. Even if the inflation data worsens to the point that it's obvious that hikes are necessary. And so that's where I think the credibility is on the line between what the Fed says and what the Fed does. And when will the central bankers be forced to accept that inflation is not going to go down to 2%? That maybe 3% is okay. And of course, if they're willing to lower the bar to 3, well, what about 4? Once you change your target, it's no longer a line in the sand, right? So if the central banks say, well, we're going to go from 2 to 3 or 2 to 2.5, whatever, why should that have any credibility, right? Especially after saying for so long, 2% is the target, 2% is the target. Trust us, it's 2%. The minute they change it to a higher number, that new number has no credibility. It has even less credibility than the old number because they were willing to change it. If they're willing to go from 2 to 2.5, they're willing to go from 3 to 4. If they're willing to go, from 2.5 to 3, if they're willing to go to 3, they're willing to go to 4. At what point would they be unwilling to compromise? Because what's the difference? And I think what happens is when the central bank is forced to abandon its target, that is a warning sign. And that is what's going to result in a loss of confidence in dollars or euros or other fiat currencies, a loss of confidence in sovereign debt, and it's going to cause a stampede into gold, into silver, into real assets, into emerging markets. So what happened on Friday was, again, a gift, an unexpected gift where people could take advantage of that and buy. Let me see where we're trading now. We're only up about $4 right now in the price of gold. We're still trading just below $2,300 an ounce at $22.98. Silver's up 29 cents, back above 29.52. It got as low as around 29.12 or 13, I think, if I can remember correctly, on Friday. So we didn't get below 29, but I think anything below 30 is a steal. We only really stayed below 30 one day last week, and then we got below it again on Friday. Interesting, gold was only down on the entire week. Gold was down, I think, 1.7%, which is not that much, right, for gold to be down on a week. And going into Friday, on Thursday of the same week, gold was up 1.9%. But if you look at the reaction in the gold mining stocks, when gold was up 1.9% in 4 days, the GDXJ, which is an index of junior mining stocks, was only up by 0.5%. That's how little gold stocks went up on almost a 2% rise in the price of gold. Now, the main reason for that was the big drop that gold stocks had on Tuesday when they were down by 4%. But gold was down only about $20 on that Tuesday. It was up about the same amount on the Monday, Wednesday, and the Thursday. So it was just one down day. But again, there is such a lack of conviction, even among the bulls, that one $20 down day scared the bejesus out of people, and they dumped their mining stocks. Well, on the week, the GDXJ was down 7% in 1 week on a 1.7% drop in gold on the week. And again, when gold was up 1.9% on the week, the day before, the GDXJ was only up 0.5%. So a fraction of the percentage gain. The stocks were up a lot less than the metal. But as soon as the metal went down, the stocks went down way more than the metal. And again, that's because whenever gold and silver go down, the gold stock traders assume it's going to keep going down. And they start discounting a future decline way beyond what's already happened into the price, and they run for the hills. So this is a huge wall of worry. I think, the weak hands, and there's pretty much almost all weak hands in this market. I don't know who the strong hands are. They're not the traders. But again, at the first sign of trouble, and they saw a lot of signs on Friday, and I think Friday turned a lot of people who may have gotten bullish on gold in the last couple of weeks bearish. And that's probably exactly what the Chinese want, right? If the Chinese started this sell-off just by announcing a 1-month hiatus, from buying gold, and that was enough to get the new buyers to throw in the towel, well, now that's more gold for the Chinese to buy. And they got a lot of gold that they need to buy, and they want as little competition as possible. It shows you, what can happen. I don't know what it's going to take now, because so many people that maybe just bought into the market in the last week or two who are now gone, right, and just thrown up their hands in disgust right? Who knows where they're going to come back in? I mean, maybe gold will have to be well above 2,500. Silver might have to be 35 or 40 before some of the people who just bought, right? Some people finally just saw the move up in silver and they bought in at maybe 31 or 32, and now they just sold out at 29. They took a loss and they said, that's it. It's over. I'm getting out. And maybe some people actually got short. They're going to be in for a world of hurt in this next rally. I read a lot of articles. A lot of people think that there's going to be a lot more selling coming. Next week we get the FOMC meeting. The Fed is not going to cut rates, obviously. And they're going to talk. I mean, most of these press conferences have been very bearish. Very dovish. And so we could see a big reaction in the gold market, in the foreign exchange market next week that completely reverses what happened this week. But you still have a lot of people that just assume that the sell-off that started on Friday is just going to continue. It may continue for a day. I mean, maybe we go down again Monday or a little bit Tuesday. But again, this is going to be, I think, short and sweet. This is a huge bull market, and people are not going to have an opportunity to buy that big a dip. I mean, I think what we just saw is about all the opportunity you're going to get. But what these declines do is they're not enough to give the bulls a really great buying opportunity. They're just enough to scare the weak longs and to prevent other people who were considering getting into the market from taking a position because they get scared. And it probably emboldens the shorts, and it probably encourages people to enter the market from the short side. But you're not going to get a big enough dip for the longs, for the bulls, to get a really good sale. I think these are short and sweet opportunities, and most people will miss them because the market pulls back, and then you're hoping that, okay, maybe we'll get a bigger pullback. I don't want to buy just yet. And the next thing you know, the market's running off to new highs. So I wouldn't expect there to be much downside below where we are now. And again, as I said on a prior podcast, I think 30 for silver is what 2,000 was for gold. I think now that we've gone through 30 an ounce, 30 is really the support. Again, we could trade below it like we are now, 29.50, just like gold went below 2,000 many times before it went to 2,400 and hasn't got anywhere near 2,000 since. I think silver is in that early stage. We just blew through 30, which was resistance for many years, which is now relative support. And I think any dip below 30 is an excellent buying opportunity. And I wouldn't press my luck looking for 28 or 27. I think the time to buy those prices has passed. I was trying to get people to buy silver when it was under 25. But if you didn't buy it when it was under 25, you could still buy it now under 30. 30 is still a big pullback from 50. 50 is where silver got in 2011. And that's where it got in 1980, right? And it's still way below that. Anyway, that's it for today's podcast. I will be back again and talk about next week. I'm planning, I think, on doing a podcast on Friday. That's going to be the day before I set sail on an 8-day cruise with the Real Estate Guys Summit at Sea. So between now and then, I'm going to be busy. I'm going to be traveling down to Florida, but I am planning on doing a podcast on Friday night of next week. So make sure and put that into your calendar. It'll be another live podcast. I'll be doing it from my hotel down in South Florida. In the meantime, if you enjoyed this podcast, don't forget, give me the thumbs up, put a comment in, share it with your friends. And I'll be back again, and we'll see what happened between this Sunday night and next Friday in the gold and silver market. Bye for now.